So we were just hearing from Germany, but of course we have seen some big national plans like the ones that we've seen in that country, but it may not be the same for some nations like in the south of Europe. So how do all of these fiscal plans work out if some countries do not have the same fiscal leeway to implement all of those measures?
Okay, so first of all, we need to realize what type of crisis are we in. And this is literally a symmetric crisis, which is affecting the world simply that it's coming in stages. So, we have China first, Italy, Spain, others will come. And therefore, there's two things to realize. One is, do you have enough liquidity? Because this is a liquidity crisis. And then thereafter, you will need funding, and especially fiscal funding, for your recovery. So we're now at the liquidity stage. And frankly speaking, this compares very, very positively the response liquidity-wise to 1929 to 2008, because central banks have reacted so much faster. This includes the ECB. The ECB has reacted enormously. So there is no risk for even Southern European countries to see spreads going up, which is basically what would really imply a liquidity issue for them at the current juncture. Of course, you then need some liquidity fiscal measures, which everybody has announced, Italy, Spain, of the order of 10 to 20% of GDP, for Germany, less so for Spain. But I think liquidity is really all about how long this lasts. If we are able to control COVID-19 in a decent amount of time, and Italy is showing the way that this is possible, Spain is behind because it started later, I think liquidity-wise we should be fine. Then we would need the recovery. And frankly speaking, because Europe is very integrated, we're all very happy to hear Germans' plans, and all of their stimulus leeway because of that low debt to GDP, because that will imply exports for the rest of Europe. So, I wouldn't be as negative. I think what had to be done, US, obviously, swap lines in dollars. This was so important for the rest of the world to avoid kind of dollar crisis. And then the ECB for its own area. I think liquidity-wise, we should be fine, and we just have to go through this as quickly as possible, containing and, of course, repressing the population from moving. This is what Europe is doing. I hope the whole world can basically do that quickly. This is the key question. How quickly can we do this so that the liquidity problem is not too big a problem for anybody?
Alicia, so where are Asian countries in this process that you describe? Whether it's in the virus containment, of course, we have seen that now stabilization starting to happen, but where are we in terms of liquidity, the markets, and the economic fallout?
Okay, so the basic difference between what I said for Europe, including Southern Europe, no matter how bad it looks, is that Europe has a reserve currency. We operate in euro. So dollar shortage is not a big issue. It can be an issue for a specific financial institution. We actually have a swap line with the Fed. The ECB does have a swap line with the Fed. For Asia, though, we only have swap lines in dollar for very few countries: Australia, South Korea, Japan, obviously, and that was earlier, and Singapore. That's all we have. We do have countries, though, which are heavily dependent on dollar liquidity. Indonesia is one. And this is very important because of capital inflows having been massive for years. So now they're leaving and they need to find dollars to leave. And then the other very obvious one is Thailand. It's not capital inflows, it's income in dollar, it's tourism. So I would basically point out that the more you depend on dollar, either income from the rest of the world or capital inflows, the harder it is for central banks to help, because the bottleneck is the access to dollar liquidity. This is why I find it absolutely essential that the IMF steps up quickly. And this is not about stigma, same with Southern European countries. This is about a shock which you basically didn't create. Nobody created this shock. So we need dollar liquidity beyond what the Fed has done for the rest of VM and for many Asian countries. We know there is a long queue there. The IMF has reported 80 requests, and we know that the funds are limited. The IMF is not the Fed. It can't issue dollars. It can't create dollars. So I think it's really the responsibility of IMF shareholders, let's put it this way, many of which are, of course, developed countries in difficulties. I realize that to really step up, because we need to stop this everywhere. Otherwise, the risk of a financial crisis is obviously in the light. So we have to give dollar liquidity to everybody who needs it. It's a liquidity crisis.
Alicia, in Asia, you're talking about regional swap lines then? Yes,
regional swap lines. I mean, I wish it was such a great idea. It's just that it didn't go as far as it should have been since 2008, where they were basically propped up after. So 97, 2008, we realized that dollar liquidity was an issue. We tried very hard to regionalize Chiang Mai initiative, but frankly, the numbers there are small, many of which are in local currency. We even have renminbi bilateral swap lines. They're nice, but they aren't big enough. So I think really we need self-insurance. Some countries have enough reserves, but we need more than that. We need regional insurance, because the IMF, or just pull the IMF and recapitalize the IMF. But if Asia doesn't go that way, which is likely because of historical reasons, which we all know about, but we don't have an Asian monetary fund. So these regional swap lines would need to be propped up as soon as possible, so that there's regional insurance, not only self-insurance, indeed.
Alicia, how likely and should we be talking more about the idea of Corona bonds? They seem to be gathering kind of increasing support within Europe for them, or is it really a big concern when it comes to packaging up debt with these highly leveraged, vulnerable countries like Portugal, like Greece?
I think Corona bonds are a great idea, because they basically target an unexpected shock that is unrelated to economic policies. So this is not Greece in 2010, or why? Because it's basically it's an external shock, and it can affect anybody. So you could, in the same way as I was proposing to prop up regional insurance in Asia, and you could even think of a regional institution issuing bonds. Could be the Asian Development Bank, the Asian Infrastructure and Investment Bank, to serve the purpose of targeted investment for the region. The same can be said for Europe, even more so, because we have a monetary union. So, we have to, in a way, forget the myth of what happened in 2010, because this is totally different. And frankly, the recovery could be very fast. These bonds could be actually quite successful in terms that they cover the immediate liquidity constraints of sectors that could eventually be very successful in the recovery. So, it's not necessarily bad money, on bad money. It's just that this is a shock we all need to go through. And that's why I believe that the Corona bonds, beyond Europe, I would argue, are a good idea.